Hey guys, welcome back to another video by Fully Informed Trade, or FI Trade for short. My name is Alex and I'm just going to go ahead and review the stock, commodity, bond, and Forex market. So without any further delay, let's go ahead and review these key markets. First of all, dollar index went ahead and continuing its long-term pullback. As you can go ahead and see, the euro-US dollar is doing the complete opposite. Similar candlestick formation on both ends of the scale, and because of that, you can conclude that there is an inverse correlation with the US dollar index and the euro-US dollar. So if you want to observe the US dollar index with even more detail, with a bit of more certainty, you gotta watch the euro-US dollar in connection with the US dollar index. Now, because of that, I feel that the euro-US dollar will have some key area of resistance at the 138 level. You gotta watch that level very closely because it will be the difference between a stock market rally or a stock market pullback. I anticipate that the Forex market will eventually pull itself back after touching that key level. And not only that, when market participants finally take their shares off the table, they start selling, taking their profits off the table when they can, when they should. What's going to happen is that you're going to see a global market meltdown where everybody's going to sell their stock. It doesn't matter whether it's in Singapore, Hong Kong, Seoul, Korea, Tokyo, Japan, London, United Kingdoms, wherever it is, it doesn't really matter. They're going to start selling their shares, and because of that, you're going to see a global market pullback, and a lot of foreign investors will they're going to sell their stock, turn it into currency, convert that currency into the US dollar. That will cause the US dollar to go up. That will cause whatever currency response that is correlated to it to go down in proportion to that currency swap, and the currency swaps will make it so that the US dollar will have more value. When it has more value, that in turn will cause the US dollar index to go up. When it goes up, the stock market will continue its downwards momentum. That's what I see with the market, and then I just summarized a 5-paragraph long seminar about correlative analysis, but that's something else for a different day. Okay, let's go ahead and look at the Dow Jones. Dow Jones Industrial Average continues to trade above 12,000, but then it has these pullbacks. It has never been able to confirm above 12,000, and the main reason why is that all these computer programs that are executing trades are because every program has an indice attached to it. And the computer indice, the programs itself are executed so that they sell once they get near a key resistance area, and one of them is most likely the 12,000 level. So every time we get above it, these computer programs, it doesn't matter what stock they're trading, they're going to sell it every time the Dow Jones Industrial Average gets to above 12,000. Once we get below 12,000 and they see a quick scalp opportunity, or the market decides to go ahead and start buying back into it, then these computer programs execute themselves to buy ahead of the market crowd and then turn around and sell to the market crowd constantly. And then eventually what happens when the market crowd no longer wants to buy, but these computer programs still have these shares to sell, they sell them by the billions and millions. They sell a ton of stock, but within millions of a second. And then it causes these minor pullbacks throughout the day as it trades above and it trades below, and it's a relatively flat day. But the main reason why you could blame the market not being able to penetrate 12,000 is because a lot of computer programs are executed not to do so. Now, and also because 70% of the volume in these light volume markets are made up by computer programs, it's going to take a ton of market participants that are real hedge funds, real mutual funds, to push above the 12,000 level. But they're not willing to do that because there's already a ton of risk at hand. And they already know, because these are professionals, guys. These guys know that if they wait a bit, they're going to see a downwards valuation in the stock, and then they can go back in and buy them. So why risk it when the only people that are trading this market right now are computer programs? So let's go ahead and look at the next chart, which is going to be the Standard & Poor's futures, not the futures, but the Standard & Poor's index ETF. Now, pretty much what happened is that I mentioned that the 130 level, it could break above it to around 130.20. We've already touched 130.20, as you guys can go ahead and see right there. But as you guys can already see in the past, and you guys could already know, I think this is going to be near the top, or has been the top. And I think that this market will eventually have a pretty decent pullback tomorrow on Friday. Because remember, a lot of market participants, the real market participants, not the computer programs, are going to start selling their stocks for the weekend because they don't really know what's going to happen over the weekend. And another thing to consider is that when these market participants start selling their stocks in anticipation to a weekend, these computer programs will execute sell orders they're pretty much what these programs are gonna do is that they're gonna sell short in front of the market crowd and turn around and buy to cover. Sell short first, buy to cover constantly. Sell short, buy to cover, and that will in turn exacerbate a market downwards movement. So let's go ahead and look at the next chart, which is going to be the Forex gold spot. Forex gold spot continues going downwards. I did mention the fact that we were on a continued downwards trend. And because of that, this trade triangle technology did point out that at 1,362, we were on a downwards trend, and it continues by saying that at 1,352 over the short term. Currently, gold is trading at 1,314. The key area of support to watch out for is the 1,285 level on the gold market. You got to watch that level very closely because you don't want to be fighting in a slugfest of bullies. Main reason is because you have the bull crowd and the bear crowd. You don't want to side with either crowd. Of course, you want to keep a bearish bias, but this support level is key. If this market can find support on this level and we can get a confirming indicator that can engulf the previous two candlestick patterns, then the likelihood of this market being able to reverse in direction is there's a high probability of it. Likewise, you shouldn't short the market, but if this market trades below the support level and it breaks that support level, then we have a high probability that this market will continue its downwards trend and you can go back and short the position. But once you see 1,285, you don't go long, you don't go short, you wait and see what the market does. And if I see what I want to see, whether it's going to be going long or going short, if the market tells me what I want to see, which is a position, whether it's long or short, but a definitive position to take on, that's when I'll start blabbing my mouth, whether it be to buy or to short. Let's go ahead and look at the next chart, which is going to be the silver spot. Silver spot, same exact story here, but it doesn't have an engulfing candlestick pattern that engulfs the previous two candles, which is okay, but there is still a downwards trend in the silver market. As you can go ahead and see with the daily and the weekly triangles, we have a negative indication of trend at 28.30, and 28 was also another place where it had a negative indication of trend. Currently, silver is trading at 26.99. Overall, the trend is relatively weak in the silver market, and you guys can go ahead and zoom back by around 5 years. You guys will see very carefully and very closely that we're looking at a similar slope from this previous pullback. And because of that, I could only assume the worst case scenario. This isn't a nice little Humpty Dumpty slant like that. This is a slant like that, guys, and we're seeing the same exact thing. We're seeing a powerful looking slant. And the more tight it is to the downside, the likelihood that it's going to be short and painful right down. And because of that, I cannot recommend you guys to buy silver at all. Next chart, bond market. Bond market trading below the 20-day moving average, but it's in the lower area of the channel. Now, because of that, what I honestly anticipate is that if you guys could at least, because, right now, since it's below the 20-day moving average, I would anticipate and look out for opportunities to buy towards the bottom of the channel. Now, if it was trading above the 20-day moving average, then we can look for areas to short above the channel. But right now, since it's towards the bottom of the channel, right now it's to look for buying opportunities. And if you ever see an opportunity where this market touches this channel again, then you can consider another long position. As you guys have seen before, we did have another long opportunity at 119.60. I didn't point it out because I don't make videos towards the morning session. But pretty much this would have been a great opportunity, golden opportunity at around 8:30 a.m. because it was towards the bottom of the channel. Now, because of that, if we have another opportunity to buy back into it at the lower end of this channel, take the opportunity and look for another exit out the 122 area. Let's go ahead and look at the next chart, which is going to be the crude oil market. Crude oil market continues on its downwards trend. I did mention that there was not an engulfing pattern that could engulf the previous two candlesticks, and the likelihood of being able to do that is nearly impossible. I mean, you need to see crude oil go up and be Superman and go up by around $5 in a single day trading session to engulf the previous two candlesticks. And we had a new indication of weakness, which is at $88.22. Right now, crude oil is trading at $85.27. And let's go ahead and look at the day's trading session to see exactly what happened. At around 10 a.m. onwards was when the crude oil market has pulled back. Let's go ahead and see what happened on the dollar index, though, on the day's trading session. At around, give or take, 10 a.m. onwards is when it had a quick rally, and then it pulls back. But at the same time, what did crude oil do at that point in time? crude oil market at 10 a.m. onwards did have a major pullback, and then it continued its downward momentum. So just a quick spike in the dollar index that was a little bit misleading was enough to make crude oil investors shake their fist, shake their knees, buckle, and sell their stock, or not their stock, but their commodity crude oil future contracts. And because of that, crude oil continued its downward trend, and if the dollar does that, and crude oil investors have no reason to buy, especially since they're buying in the middle of a downtrend, they're going to get their white knuckles and they're going to get their sissy butts out of there. That's just the way the markets work. Let's look at the next chart, which is going to be Tech Resources B, which is pretty much Tech Resources, a coal mining company. The coal mining company is finding there's going to be a great trade once we reach the $58 level. Great opportunity there. It could bounce off that and touch the 20-day moving average. That's when you probably get out of your position. But if it breaks below this 20-day, if it breaks below the support area, then yeah, this market could go all the way down to around the $48, $40, $50 level. Now I want to point out a key characteristic here. It is on a downtrend. So if you were to buy this, you would buy it, and you would set a tight stop right below the support level. The main reason being is that you don't want to lose more than whatever you're risking. And another thing is that if it bounces off this and it goes to the 20-day moving average, take the opportunity to get rid of your position, because this market has not been able to confirm above the 20-day moving average twice. In fact, I honestly feel that the longer term, coal is attractive. But right now, coal isn't exactly attractive. It is attractive for a short-term scalp, whether it be short or long. If it breaks below this if it breaks below this trend line, feel free to go ahead and short it. If it touches the support line, feel free to buy it, but place a tight stop below this trend line and sell it when it reaches the 20-day moving average. That's all for Tech Resources. Next chart is going to be the Las Vegas Sands. Las Vegas Sands does bounce right off this support level, which I should have pointed out. But you know what? When I looked at it, it had this engulfing pattern below this candlestick. Now, below this support level, but now it's touching the 20-day moving average, and if it can't break below that or confirm below it, then the market will continue going lower on Las Vegas Sands. And if it goes lower by not being able to break the 20-day moving average, it will break below that key support level and continue downwards into the $40 and $35 level. That is all for today, guys. Please be sure to keep on checking out my videos on YouTube for the coming weeks and months ahead. If you guys want to use the same charting software that I use, please be sure to check out the link below this video. And also, please be sure to tell your friends on Facebook if they want to learn more about stocks, commodities, bonds, and Forex. And also, subscribe to my YouTube channel. It helps a ton if you guys support me. That's all for today, guys, and I'll see you guys in the next coming weeks and months ahead.